Investing in the stock market can be intimidating for beginners. There are thousands of companies in the stock market to choose from. And how do you know which one is the best? Another problem for the beginning investor is to find out which brokerage to choose from, or he or she just invests through a financial advisor. In the end, they end up taking no action to achieve their financial goals. Hi, I'm Joel, a teacher working in Singapore. I make videos on productivity, personal development, and lifestyle hacks. If you love this content, do consider subscribing to the channel so that you don't miss any videos. In this video, I'm going to share one simple method to invest in the stock market. Now, all information shared here is for education purpose only and should not be taken as investment advice. You can implement this at your own risk and after consulting your financial advisor. Before I go on to share the method, I have one question for you. What is stopping you from investing in the stock market? Is it A, I think investing in the stock market is too risky? B, I don't know how to do it? C, I don't have the money to invest now? Or D, other reasons? Let me know your answer in the comment section below. So the method that I want to share is called dollar cost averaging. This method is a great way to start investing and grow your wealth over time. It's also a good strategy for those who don't have enough money to invest all at once or want to avoid making emotional decisions about when to buy or sell stocks. So how does it work? This investment technique involves buying equal dollar amounts of a particular asset on a regular schedule, regardless of price fluctuations between purchases. This allows you to take advantage of the dips in the market without having too much invested at any one time, and helps you to build up your portfolio slowly but surely over time. Let me give you an illustration. Let's say you set aside $200 to invest every month and you decided on this particular stock or fund or ETF. If the asset cost $4 in January, you can buy 50 units for $200. If it rises up to $5 in February, the $200 will buy you 40 units. In March, if the asset drops to $3.50, you will buy about 57 units. This goes on and on. If the price of the asset goes up, you buy lesser units with the $200. If the price goes down, you will buy more units. Over time, you will accumulate more and more units of the asset, and the cost of buying the asset is averaged out. In the long run, when the asset appreciates in value, you will make money. So far so good? Let's talk about the benefits of dollar cost averaging. The first benefit is that this strategy is used to avoid market timing, which can be difficult and risky. There's a saying that goes like this: time in the market is more important than timing the market. Market timing is not a pure science that many investors, even professionals, can master. Investing a lump sum at the wrong time can be risky, which can adversely affect a portfolio's value significantly. It is difficult to predict market swings, hence, the dollar cost averaging strategy will provide a smoothing of the cost of purchase, which can benefit you, the investor. The second benefit is that you avoid putting all the eggs in one basket. You mitigate volatility and risk. Dollar cost averaging reduces investment risk, and capital is preserved to avoid a market crash. It preserves money, which provides liquidity and flexibility in managing an investment portfolio. Dollar cost averaging avoids the disadvantage of lump sum investing through the purchase of a security when its price is artificially inflated due to market sentiment, which results in the purchase of a lower than required quantity of a security. When a security price discovers its intrinsic price through a market correction or the bubble burst, an investor's portfolio will decline. Some downturns are prolonged, further diminishing portfolio net worth. So using dollar cost averaging ensures minimum loss and possibly high returns. Dollar cost averaging can reduce regret feelings through its provision of short-term downside protection against a swift deterioration in the security price. A declining market is often viewed as a buying opportunity. Hence, dollar cost averaging can significantly boost long-term portfolio return potential when the market starts to rise. Next, dollar cost averaging takes emotion out of the picture. The use of dollar cost averaging eliminates or reduces emotional investing. A disciplined buying strategy through dollar cost averaging makes the investor focus their energy on the task at hand and eliminates news and information hype from various media about the stock market's short-term performance and direction. Next, you can start investing sooner with little money. $100 is enough to start. Nowadays, there are more and more institutions allowing investors to start their investment journey from as low as $100. You might be focusing on repaying your debt, so you don't have a lot of spare cash every month. By allocating a small sum to invest, you don't miss out the returns in the long run. Building up from the previous point, dollar cost averaging instills discipline. It ensures that you regularly set aside money to invest. The strategy of adding money regularly to an investment account allows disciplined saving, as the portfolio balance increases even when its present assets are depreciating. Lastly, I love the hands-off approach. You can set it and forget it. There's no need to constantly monitor the portfolio. It is also good for an investor who does not like to do research on individual companies and read all the financial statements, etc. Of course, there's no perfect solution in investing. Let's talk about some potential drawbacks of dollar cost averaging. Firstly, higher transaction cost. Each monthly investment accumulates transaction fees that could stack up. By systematically purchasing securities in small amounts over a certain period, investors run the risk of incurring high transaction costs, which can have the potential to offset the gains accrued by the current assets in the portfolio. Therefore, it is important to check the fees charged by the institution before you start investing with them. Secondly, the returns are lower than lump sum investing. Lump sum investing has shown to outperform dollar cost averaging in the long run. When we use dollar cost averaging strategy to reduce risk, it will inevitably lead to lower returns. The market typically experiences longer sustained bull markets of rising prices than opposite. Thus, a dollar cost averaging investor is more likely to lose out on asset appreciation and greater gains than one that invests a lump sum. A study by US-based investment advisor Vanguard in 2012 revealed that historically 66% of the time, a lump sum investment will have produced a much higher returns than dollar cost averaging. Therefore, in my opinion, dollar cost averaging is good when you don't have a lump sum of money to invest. If you happen to have a sum of money, say $10,000 due to getting your bonuses or selling something, don't do dollar cost averaging of $100 per month. It will take 8 years to complete. You will lose out all the potential gains. When you have a lump sum of money to invest, you may want to divide into 3 tranches to invest instead. If you are convinced of the dollar cost averaging method, I'm sure your next 2 questions will be how to start dollar cost averaging and what to invest in. Firstly, you need to research which institution in your country allows you to do regular, weekly or monthly investments. They could be banks or brokerages like Fidelity or TD Ameritrade. You can contribute an amount that you're comfortable with, say $100, and invest in an ETF like Vanguard Total Stock Market Index Fund or simply the S&P 500 Index Fund. I live in Singapore and there are many institutions that offer their platforms to do regular investment. For example, OCBC offers Blue Chip Investment Program. Poems from Phillip Securities also offers regular investment plan. There are also robo-advisors companies like Stashaway, SIF, and Dowers, etc. that you can register with and start your monthly investment journey. In fact, I have accounts with all 3 robo-advisors. In this video, I'll show you the Stashaway platform and the results so far. Let's jump into my laptop now. Alright, here we are at the Stashaway website. Stashaway is a robo-advisor platform that allows you to invest your cash by creating portfolios based on your risk appetite. They are regulated by the MAS. So you will get your own portfolio with a strategy designed just for you. That means a mix of equities, bonds, and cash that reflects your profile, not someone else's. They will personalize your portfolio but remain objective and efficient so that they can put precision, protection, and peace of mind into every dollar you invest. You can go to their pricing page right at the bottom. Over here, you can click on pricing to check the fees that they are charging. Now, for the first $25,000, they will charge an annual fee rate of 0.8%, and any additional amount above $25,000 up to $50,000, they will charge an annual fee rate of 0.7%. To me, it's pretty reasonable, but I'm not sure about you. Okay, so let's go to my portfolio. Okay, so let me show you my portfolio that started in August 2017. Over here on this chart. Now, initially, I put a lump sum of $6,000 in August 2017. Then after that, I set up a monthly $300 deposit. So if I go to the assets page right here, okay, you can see that this portfolio consists of a mixture of bonds and equities. It's pretty balanced, and the company will re-optimize the portfolio based on the economic conditions. So right now, this is my 4th year investing with them, and so far you can see over here the portfolio is up 26%, considering I do not have to constantly monitor the portfolio. In fact, last year when the market tanked in March, I'm surprised the portfolio did not go into heavy losses. Okay, I was still up a little bit. You can see the dip, but it did not go into losses. So when the market picked up later part of the year, the portfolio went up as well. So overall, I'm quite happy with this portfolio. I don't expect this to outperform the market, but at least this portfolio is not so volatile and I can sleep well at night. If you are interested in the Stashaway platform, you can sign up using my referral link below. There are many platforms out there, and this video is not about comparing the different platforms. The most important thing is to pick one and take action. We need time to let our money grow. In conclusion, dollar cost averaging is an investment strategy that allows you to buy stocks at different price points, which lowers your risk. It gives you the opportunity to purchase more shares when prices are low and less when they are high. This means dollar cost averaging can help you grow wealth over time in a way that minimizes your downside risk and increases your upside potential. Let me know in the comment section below which method of investing have you used and what kind of results did it produce for you. If you like this video, I would greatly appreciate that you hit the like button and subscribe to the channel. It will help the channel a lot. That's all for today's video. I'll see you in the next one. Bye!